All right, so let's check out some problems in Chapter 3. We're going to first look at some accrual-based revenue problems and also some accrual-based expenses. And then we'll do some recording and posting of some journal entries on your adjusting entries, and also look at the T accounts. All right, so first one we'll take a look at. This is exercise 3-4. And in a moment, I'm going to start the actual PowerPoint slide because this particular slide takes you step by step with all these animations, so it's easier if I just start the slide in a moment. But just to kind of show you on this particular problem, we've got A through F, and on each one of these, we got the following transactions occurred in October, and it says, you know, we want to see, for example, if the revenue is going to be recognized in October, and if so, what amount, and if it's not recognized, and trying to figure out just exactly why it's not. All right, so let me get this set up. And let's start from the current slide. And so again, we'll start with part A. Let me go ahead and click to the next one. And the transaction is, it says a customer paid $20 cash for 15 song files from the Sync eTone store. So this to me looks like it would be a revenue item, and the amount that should be recognized, because the customer is allowed to download the songs. It's essentially, this is a transaction where they paid money. So the amount that you would recognize as revenue in the month of October should be $20. All right, next one. We've got Comfort Depot provided a carpet installation for $2,600 cash. A comparable installation from other companies cost $3,100. So it looks like they've actually provided the service. They got a transaction price that has been established. They've got the cash, but more importantly, they've actually earned it. So in this one, again, the service has been provided, so the amount that you would recognize is $2,600. The $3,100 is irrelevant because $2,600 is what this particular customer charged. All right, on the next one, here on. It says that Ignite Company is scheduled to install digital cable at 600 homes in Georgetown next week. So this is the schedule. It says the installation charge is $120 per home. The terms require payment within 45 days of installation. So notice it says they're scheduled to install, but they actually haven't done the work yet. So in this case, what they say, only promises are exchanged, so nothing will be recorded in October. Once they start to work on the actual homes to do these installations, that's when you would start to recognize the revenue. All right, now in this one it says Ignite completed the installations of the digital cable. So like I just said, at that point in time, they have fulfilled this obligation. So all the money would be recognized once they've actually performed the service. All right, and let me go to the next one. All right. So this one says they receive payment from customers for installation of the digital cable. So in this case, it's like saying they billed them later. You've already recognized the revenue. So in that case, in terms of revenue recognition, it's zero. Although the cash flow would be increasing. Remember, there's always a timing difference in cash flow and revenue recognition quite often. But in this case, it's just the revenue part won't be recognized because it's already been recognized. All right, another customer purchased a ticket from Cooper Airlines in October for $600 cash to travel in December. So this is an advance. They haven't actually traveled yet. So the airline company, even though they may have the money, for them it would be deferred revenue. So nothing's recognized just yet. All right, 3-5, we got some more transactions to take a look at. So the first one says the Clayton Company issued $28 million in new common stock. And again, common stock is not a revenue item. Remember, that's an investment item. All they got coming in is cash. And so remember, that would be under common stock, under equity. That's not under retained earnings. All right, next one, Leonard University received $25 million cash for a 900,000 5-game season football tickets. None of the games have been played. That's the key. Nothing's been played. Nothing's been earned. So again, this is a prepayment. So no revenue is recognized. Typically, you recognize it as you go, as you earn the games. So again, like I said, this would be a deferred liability. Leonard played the first football game referred to in the previous transaction. So essentially, 1 out of 5 or 20% would be recognized. 20% of that 25 million would be recognized as revenue. Smith Construction Company signed a contract with the customer for the construction of a new $450,000 warehouse. At the signing, Smith received a check for $48,000 as a deposit to be applied against amounts earned during the first phase of construction. So from Smith's standpoint, that $48,000 is an advance. Nothing's been earned, not until it's been completed. So again, nothing would be recognized as revenue just yet, not until you start to actually work on the construction. E, a popular snowboarding magazine, received a total of $2,000 today from subscribers. It begins next fiscal year. Again, this is a prepayment, so this would be unearned or deferred revenue, and $0 is recognized. All right, Syntex Mobile sold a $180 cell phone plan. This happened in September to a customer who charged the sale on his credit card. Answer from the standpoint of Syntex. Well, guys, credit card is essentially the same as cash. And so in this case, all of it gets recognized as revenue. All right, so that would take care of that one. Now, I think on the next ones, yeah, I'm going to leave up the PowerPoint slide. Once I get past these first transactions, I'll put it back to the view mode. All right, so we got some more, and we're going to go and now look at the expense side. When would the expenses actually be recognized as incurred? So we've got Lenovo paid us computer service techs $88,500, and again, this is for salary work done in January. Answer from the standpoint, how much of this expense would be incurred in January? Well, it looks like they have actually performed the service. They've actually done the work. So in this case, it looks like, if I get my mouse going here, it looks like all of it should be recorded as expense, because at this point in time, that expense all should be matched against the revenue that's going to be incurring or going to be recognized in January as well. At the beginning of January, they paid $3,500 in rent for February through April. Again, that's going to be a prepaid expense. So those expenses won't be recognized till the months of February through April. So in this case, you'd be saying $0. The publishers used $36.50 worth of electricity and natural gas in January, which has not been paid. Well, they've incurred it. So January, they're in revenue. So this expense should be matched against the January revenue. So all of this should be recorded as an expense. William Smith Company received and paid in January an invoice from a consulting firm for services received in January. So again, all of this was pretty much a cash payment that for an expense that was incurred in the same month. So all of that would be an expense. The campus bookstore received consulting services at a cost of $48.90. The terms indicate that payment is due within 30 days of the consultation. Well, if they've actually received it, then that means that the expense has been incurred. So all of that should be recognized as expense. Cooper's Incorporated had its delivery van repaired in January for $320 and charged it. So even though they haven't paid for it, they've incurred it. So all of that again should be charged to expense in January. All right. Now the next one, I'm going to switch to the other view because it'll be easier for me to annotate on it, but let me just end that part right there. So on 3-13, we'll take a look at these T accounts again and look at some transactions. I'm just doing some basic journal entries and posting. Just some of this may seem a little bit like review, but let's check it out. Looks like we've got, they want you to set up the T accounts. This is essentially your ledger. And then we've got all these transactions we want to look at and then post them. And then at some point in time, they want us to end this with doing an income statement and a classified balance sheet. All right. So as you can see, they set up all these T accounts. Here's your assets, your liabilities, your equity items. Notice the balances for your assets are on the normal debit side because that's where they increase. Liabilities is on the credit side. That's where they increase. And we only had common stock and retained earnings set up. Notice all the temporary accounts are at 0. All right, so just to kind of go through some of these transactions, we'll look at the analysis, the journal entry, and then the ledger posting. So in the first one, looks like we have a sale, a cash sale, and a part credit sale. As you can see, we've got $30,000, $10,000 is going to be accounts receivable. So you're going to be debiting cash for 20,000, debiting AR for 10, and then the credit goes to your sales revenue of 30. All right, next one looks like we have some revenue. This is going to be cash revenue. We rented a building. It was $1,200 rent. It was received in the month. So the timing is we just debit cash, credit, rent, revenue. And of course, you can see the posting to your ledger. All right, next one looks like we've got money that's going to be paid in advance because we're not going to be providing the service in January. So we've got the money. So we're going to put this under a liability account called deferred revenue. So debit cash and credit deferred revenue. All right, we've got simply purchase supplies for cash. You've seen this one from your applied accounting days, but again, you just debit supplies, credit cash, and then here's your respective postings. All right, next one is we've got money coming in from a credit client. And as you note, we simply increase cash by a debit and decrease accounts receivable, and then you post to your ledger. Next one, we've ordered the furniture. We haven't received anything yet. Usually they don't charge until it's been shipped. So in this case, there would be no entry. Next one, we've got the gas and utility bill. We're not going to pay it till next month, but because we've already incurred it for the month of January, you still go ahead and accrue that expense. So you debit the expense and credit most likely accounts payable. And I think there's one more. We paid the wages for January. So this is just simply going to be a wages expense debit and a cash credit, and then again, post to your ledger. And then here's the final summary. Think of this as your ledger, like the T account setup. Notice you got cash with a debit balance. All your assets have debit balances, so that would be normal. All your liabilities have credit balances, so that's normal. And then you've got your equity, you got retained earnings, you got a sales revenue and a rent revenue. On the credit side, that's normal and appropriate. And you got two expenses with debit balances. So the next step would be to see if you wanted to do a trial balance. To make sure, I'm going to skip right to the trial balance. You just enter the numbers from your ledger. And of course, you would show that your debits, when I get to it, your debits equal your credits. So again, this is just summarizing your ledger. Again, notice all your debits right here, 83.7 equal all your credits of 83.7. So then the next step I think they want you to do is your financial statements. You could do an income statement. So remember, on your income statement, you just want revenues and expenses. So there was two revenues and two expenses. So you add up your revenues, add up your expenses, and you subtract expenses from revenues. You get 13,200 net income because you have more revenues than expenses. And remember, this net income would then eventually get transferred into retained earnings. That would be part of retained earnings whenever you would get to the balance sheet. And on this one, finally, here is all of your assets listed, total assets of 65.7. You've got, in this case, current liabilities. You got accounts payable and deferred revenue, two of them. So the total current liabilities, you have a long-term debt of 15, total liabilities of 31.9. And of course, you had common stock of 13,000. And then they didn't show you in this one, but you had retained earnings of 7,600. That would have been like a beginning balance. But if you go back, and let me just kind of go back and show you that retained earnings from your T account for a moment, just so you can see where that's coming from. So again, retained earnings, again, this was from the balance already in there. That was to start, that was to start the period. So this 7,600, you're just going to add net income to that, and it does not look like there was any dividend. So you just take that 7,600 and add that net income, and that's how they would have gotten that new balance for retained earnings. And so in this case, they came up with a new balance of 20,800. And of course, if you look at, you've got total liabilities and equity equals your total assets on your balance sheet. All right, we've got one more. This is just looking at some transactions they wanting you to post. So this is a little bit more repeat stuff. And notice you've got A through I. And notice how we've got beginning account balances. They just entered these. This is just like your ledger. And again, just kind of pay attention as you're reviewing and practicing where the appropriate side of the T account, if it's an asset or a liability, again, or if it's an equity item, that you put those balances on the appropriate side. And then here, they're just going to be showing you how the individual post would go into your ledger. So again, you've got receiving cash. Notice you've got a debit to cash and a credit to your service revenue. And this one, you bought some equipment. You got 20% cash, 80% will be on accounts payable. But in this case, I guess it'll be notes payable because it says note due in 2 years, not within 60 days. So there should be a note payable. That's going to be right there. So you notice you've got your equipment of 14. You got your cash of 28. That's the 20%. And then the balance is 11,002. We've got receiving cash for consulting services. But again, this is going to be like a prepayment. So what's going to happen is we've got the cash, and the offset to that should be going to a deferred liability account. So it's going to go to deferred revenue of 8,000. We've got bought and received $1,500 supplies on account. So again, you'll be debiting supplies right here and then crediting accounts payable right there. We've got received the utility bill for January. It's not due till February, but we still have to record that as an expense. So we've got the utility expense right here, and then most likely just put that under accounts payable as a credit. So debit your utilities expense and credit accounts payable. We've got some consulting fees. We actually consulted, and that basically is saying you perform the obligation. So we can actually record that as revenue. So that 16.3 gets to go to service revenue, but because we do not have the cash yet, we would debit accounts receivable. All right, a couple more. 53, received $12,004 in cash for services rendered in December. So you can see here we've got the 12,400, and then I'm looking for, in this case, this is for the month of, I'm sorry, this is just a collection of cash, I received the cash. So this is just a collection on account. So you're just shifting it from your accounts receivable. So they're collecting from your credit client. So 12,000 for debit to cash and then credit to accounts receivable. All right, I think there's like one more. Paid the supplies, says paid $550 towards supplies purchased in line E. So that's just like the other one. So notice we've got the cash coming out of there, our credit cash, and then we're debiting accounts payable. And then at the end, you can see the summary. This is a nice little practice review problem. These would be all the balances. And even at this point, they didn't have you do it, but you could do a trial balance. You could do your income statement, retained earnings, and balance sheet if they had asked, but they didn't. But again, it's a good practice problem just to make sure you understand the concept of your posting, and that what your ledger does is it summarizes all of your postings. And they didn't show the journal entries in this one. I do not know why they did not, but either way, typically you would have your journal and then of course your ledger. All right, I believe that's it on my comments for the Chapter 3 textbook problem.